What I want to look at in this video relates to the world of private credit, which is essentially part of the shadow banking sector. And as is now widely accepted, there are quite serious concerns around private credit. Quite a number of loans which have been granted by these, say, alternative asset management funds in the world of private credit. Quite a lot of the loans are now beginning to default or create serious concerns that the cash flows of the companies to whom the money's been lent are no longer able to continue servicing the interest payments on the loans and so on. Now, this is often seen as a credit risk problem, which it is, of course, but I also want to focus on the issues relating to liquidity risk, which have been highlighted very recently by the attempts by some of the private credit funds to limit withdrawals or gate redemptions on their shareholders. So let us have a look at this recent article from Bloomberg, and it relates to BlackRock, and the headline, as you can see, says private credit's gate crashes are forcing funds, so it actually covers more than just BlackRock really, into a brutal spot. The world's largest alternative asset managers, of which of course BlackRock is the world's largest asset manager with somewhere around $14 trillion worth of assets. Just to give some context to that number, JP Morgan, probably the world's largest bank, at least in the Western world, has a balance sheet of around between 4 and 5 trillion. So the headline basically goes on to say that these large alternative asset managers are confronting a painful choice. They can either block investors who want to exit private debt funds, which of course is one of the funds that these alternative asset management companies offer, and deal with potential blowback, or honor the requests and betray their guiding principles. So basically what Bloomberg is saying is that because of the current nervousness in the world of private credit, which has hit many funds, including Blue Owl, Apollo Management, and Blackstone and BlackRock, the companies are having to acknowledge the fact that many of the investors want to redeem, they want to sell their shares, they want to cash out, as it were, and this is posing a problem for them because they essentially own illiquid assets, in other words, loans that have been granted to the companies that, say, Blue Owl, BlackRock have loaned money to. Many of these loans are now troubled for many reasons, and then what does a private credit firm face? They can either sell loans to become liquid, to be able to honor the redemption requests, or they can impose gates or restrictions on the fund's shareholders to be able to withdraw their funds. So just to continue with what the article from Bloomberg says, that BlackRock has gated redemptions. It has capped withdrawals from its $26 billion HPS corporate lending fund, and they have gated or limited the redemptions at 5%. Now, during the first part of March, many of the investors in that fund, reading all the headlines about problems that are taking place in private credit, specifically Blue Owl, and I mentioned Apollo Management and so on, investors were trying to redeem their holdings, i.e. sell their shares, at an amount which was nearly double the 5% that the 5% gate that BlackRock has imposed. And the article from Bloomberg says it risks generating a backlash from retail investors who are growing increasingly anxious to access their money, and in so doing reinforces the dangers long expressed by industry skeptics of selling illiquid assets to a twitchy customer base. Here really is the heart of the problem. You could construe this as a credit risk problem, which perhaps it is, in the sense that the loans being granted by many of these private credit firms are to companies that may well be suffering from, for example, disruption coming from AI, that their cash flows are much more suspect than they may have been a year or two ago, and you could thereby kind of construe this as a credit risk problem. But in some ways, it's more of a liquidity risk problem. It's the same problem that banks can confront. If you've granted, say, a loan to a customer or even, say, a mortgage, it's very hard to liquidate that loan. There are various ways of doing so via securitization channels and so on, but you also have the obligation to honor withdrawals. Depositors want to withdraw their funds, and in essence, it's exactly the same problem that the private credit industry faces, which is that they hold these long-term loans granted to the various companies, their clients, the people they've loaned money to, but they have also sold shares, which effectively are a liability. And if the shareholders, for reasons that I've just explained, get nervous and they want to redeem their funds, this poses a liquidity problem. So in many ways, the problems in the private credit industry are a version of a problem which has existed really in any kind of asset management or even the banking world, which is this essential mismatch between your assets and your liabilities. Just to illustrate some of the damage that's been taking place within the private credit world, we can see this chart here from BlackRock, which I have captured on March 10, 2026. In fact, the last day over here on the right is from the 9th of March, but we can see the big drop here. This was actually on the day that BlackRock announced this gate, this 5% gate effectively. This brought us down to this level here on March the 9th, which was a relief rally in the markets as a result of news that maybe troubles in the Middle East might not be going on for too much longer. Anyway, there was a relief rally here, but we can see the big drop down here, a big gap and a big drop down here. You can see the sort of technical damage that's been done here. We have crossovers. We even have the red line, which is the 50-day moving average, on the verge of crossing below the 200-day moving average, which is quite a bearish signal. Finally, let me just point to another chart which I have obtained from the FRED database, which is the database managed by the St. Louis branch of the Federal Reserve. And what I wanted to do here was illustrate what's known as the high yield spread, but I wanted to focus specifically on the lowest sub-investment grade bonds. These are bonds that are sub-investment grade or high yield, and they have ratings of CCC or below. And what is happening here is we're taking the yield. This is an index from the Bank of America. We're taking the yields on these very risky sub-investment grade bonds and comparing them, say, to the yield on a 10-year treasury. This has been moving up quite noticeably during the latter part of February and March, and we're now at this level of 959 basis points. Well, I hope very much that you found that video to be of interest and of some value. And could I then suggest that you subscribe to my YouTube channel, the Corcoran Codex, where the theme of my channel is to analyze critical ideas and episodes in the world of global finance. There is no obligation for subscribing, but you will then benefit from being notified as to when I add new videos, which I do on a fairly regular basis. Thank you very much for watching.